Okay, well, let's begin. My name's Brien Lundin. I represent Gold Newsletter. You can find me at goldnewsletter.com. It is the oldest precious metals advisory in the world. I also host and produce the New Orleans Investment Conference this fall. That's November 1st through the 4th, and that is the oldest investment event in the world. I started all of these when I was 5 years old, and Jim Blanchard is the kind of icon in the hard money movement, gold movement, that I went to work for as a junior copywriter back in the mid-'80s, and eventually became a junior partner in his operation and bought the rest around 2000 after he had passed away from his estate. So all of this is due to his vision and his charisma and his insights, and part of that is that I got from Jim is an appreciation for history and gold's role in the world, not as a commodity. As you all probably know if you're here, gold is not just your regular everyday commodity. It is a monetary metal. It is the most important monetary metal. It is money. So I'm going to explore a little bit about that, a little on that, if I can get this back up, and go over that a little bit and tell you where we are in some cycles, where we are in some long-term cycles, and why I believe that in a financial cycle, we are destined, we're on an irreversible course toward much higher gold prices. Gold is one of those things where, ironically or unfortunately, the near term, or fortunately, the near term is much less certain in the long term. We know that prices are going to go up over the long term, and I'm going to show you why. Here's why. National debt. This number is, I didn't even bother updating this. It's up by a few $100 billion since I did it a couple months ago. But the national debt, that's debt per citizen of $67,000. You have a child today, he's already in the hawk by $67,000 and growing. Per taxpayer, it's $181,000. This is the trajectory of that debt. These charts, you'll see a few of these in my presentation, are done by a gentleman, a good friend of mine named Ron Grease, who runs the chartstore.com. His weekly chart blog has charts like this every week, every asset class, really interesting stuff. This is a chart he did showing the trajectory in the federal debt since 1900, which was 13 years before the Federal Reserve was enacted, was launched. As you can see from this chart, you can probably see about the time or place where the Federal Reserve came into play. The Federal Reserve is owned by banks. It is the central bank of the banking system. Its raison d'etre is to preserve the banking system and foster its growth. The debt now is growing at a trend rate of 8.7539%. There's really no other financial asset out there that can boast of such a remarkable track record of growth, if only you could invest in that. I'll show you actually how you can invest in that on an inverse relationship, as it were. But the debt, if it continues at this rate, will reach $25 trillion by essentially next year. It'll reach $30 trillion by July 2022. Now, the Congressional Budget Office put out a scary warning about a year ago, saying that over the next 10 years, the federal debt will grow to $30 trillion, and they put that study out to scare the living daylights out of the public and say this is a real issue. In fact, the federal debt has doubled under the 8-year terms of all recent presidents. By that measure, if Donald Trump makes it to 8 years, it'll actually be $40 trillion. But as you can see, just on its long-term, very long-term trend line, it'll be $30 trillion within a couple of years. People don't appreciate how quickly the debt is growing. Now let's talk about some other things that people don't appreciate or even know about, things you won't see reported in the financial media. Okay, the federal deficit for 2018 came in at only $793 billion. That's a lot. But for the fiscal year 2018, that was ended September 30th, the federal debt had grown 1.2 trillion. 1.2 trillion, not 793 billion, which was the deficit, but 1.2 trillion. The difference, about 400 to 500 billion in annual off-budget spending. This is spending that happens automatically that you don't see. And if we ran our books for our companies like this, we'd be in jail. The result, however, is that the debt is growing much more quickly than most realize. And here's the clincher. It's accelerating at this point. The debt grew 1 trillion in just the last 6 months of fiscal 2018. Now, I'm not saying that we're going to have $2 trillion deficits, but that was the run rate for the last 6 months. And they just reported last week, I believe, that the federal deficit so far this year has already roughly equaled all of last year. Now, analysts are decrying that the fact that the federal debt will go to 30 trillion in the next 10 years, as I just mentioned, but in fact, it will reach 30 trillion within the next 3 years. Actually, 2.5 years. At this rate of growth, it will reach $30 trillion. So the federal debt is already out of control. Don't believe anybody who tells you that it's getting out of control and this is a problem that we have to address before it really gets out of control. It's already out of control. You cannot address the debt in any meaningful fashion at these levels except for what I'm about to show you. And this gets into the implications. First thing you need to know, this is nothing new. There's a lot of things that are different about the world today. Things move more quickly, they're more expansive, a lot of things are different. But the fundamental fact is, civilizations have always overspent their means. As Cicero said, to be ignorant of what occurred before you were born is to always remain a child. We need to be adults here and realize that civilizations have always overspent, whether through wars, entitlements, bread and circuses, they've always overspent. And the solution always and everywhere has been to devalue the debt by devaluing the currency. In the U.S., the debt is already so large we can't address it by raising taxes. We cannot grow our way out of it by this point. And God knows it's impossible to cut spending. So the only thing that can address that, the only way out of this is by devaluing the currency. It's going to happen. Let's look at some examples from history. The devaluation of the Roman denarius. As it so happens, the Roman denarius, as you can see, had a plummeting period there. That's about 200 years, 250 years, where it lost about 80% or 85% of its value. No, actually, it was more than that. But during that period, an emperor had an 84% chance of being killed, being deposed violently because of the economic and other factors, but primarily the economic situation in Rome. That was a cause. The devaluation of the denarius was the cause behind that. Now, we're very fortunate today in that we have elections. Otherwise, Jimmy Carter may have been escorted to the gallows or been knifed in the back by one of his cabinet members. But this is what I'm going to show you. This period of about 50 years or so, the denarius lost about 85% of its value during that period. When else has this happened? Well, it's actually already happened here. If you go back to 1965, where I began this chart, which not coincidentally was when they took silver out of the United States coinage. So that was really our first divorce from such a standard, monetary standard. Since that period of time, the dollar's lost about 87%, a little more than 87% of its value. So people who tell you that we're not Argentina, we're not ancient Rome, it can't happen here, well, it already has happened. And one of the reasons why, you talk about the analogy of the frog and boiling water, it happens slowly. But it's actually happened within most of our lifetimes in this room. But one of the reasons why we don't quite pick up on it is because we do have elections. We elect somebody new who's going to blame it on the other guy. But it's happening, and it keeps happening. And even at 2% inflation that the Fed wants, it still happens quite rapidly. Now, if you see this, I've drawn a big red arrow just so nobody can mistake the direction that the purchasing power of the dollar is going. So I did the same thing here. This is the value, the price rather, of gold over the long term. This chart goes back roughly the same period, 1970. And obviously there are some really dizzying rises and stomach-churning falls and a lot of wiggles along the line, but the big long-term picture is while the dollar's going down, gold's going up. That's the thing you need to realize. While the dollar is being devalued, while any fiat currency is being devalued, it's being devalued by something real. Now today we have floating exchange rates where currencies can go up and down. They have dollar index, they have the euro versus the dollar, all of these different things. That's an illusion. Those are fiat currencies rising and falling against themselves. That's like two people jump out of an airplane or skydiving, and one guy just does a nosedive and he's falling faster than the other guy who's spread eagled. He looks up and says, wow, he's not falling, but I am. The fact of the matter is they're both hurtling toward the ground. They both are, so it's always relative. All the currencies today, and that's the thing that's different today. The thing that's different today from times of ancient Rome or any other time in history, we're a connected global economy. Every developed nation, every developed economy has built up the same debt load, unmanageable debt load. So they're all devaluing their currencies. They're trying to get a trade advantage against their competitors, but they can't because everybody else is devaluing. They're racing to the bottom of the hill together. Some leading, some lagging, but all going in the same direction. So what are they devaluing against? This chart shows you that over the long term, it is gold. Just a little bit of an aside here. If you want to see how things got out of control, if you want to see really when central bankers got the keys to the car, they were like teenagers. They had been held in restraint all this time, and all of a sudden, the government gave them the keys to the car, financial car, and a bottle of Jack Daniels. And this is what they did. This is the end of dollar convertibility where that red arrow points. That's when they closed the gold window in 1971. And look what happened. They very quickly ran the car into the ditch. That wasn't Bretton. Bretton Woods was in place post-World War II. This was when Nixon closed the gold window because the dollar was convertible into gold for foreign nations. And that old crafty fox de Gaulle realized that with the Vietnam War and all the entitlements of the 1960s that the dollar really wasn't worth what it should be. So they started sending their dollars back to the United States and asking for gold in return. So Fort Knox was being drained dry. And we can say a lot of things about Nixon, but he really had no choice at that point if we were to keep our gold. So he closed the window, but that allowed the central bankers, the Federal Reserve, and the Treasury to print at will supposedly without repercussions. But as we can see, they quickly were. That's the Consumer Price Index showing the rate of inflation post that period. So the second implication we have here is that ultra-low interest rates are here for good. This is important. We will never, ever have normal interest rates. Throughout human history, the average rate of interest has been 6%. That's kind of the normal rate. That's what tends to restrain these cycles. That tends to make gold less valuable because there's a holding cost to gold. You don't earn anything. So at ultra low rates of 0 to 1%, the real rate, well, I'll get to that in a second. Let's just look at why it's like this. The federal debt during this period of ultra low interest rates, 5,000-year lows in interest rates, negative interest rates on sovereign bonds. This never happened before in world history. So this period actually encouraged debt growth. During this period, we saw a lot of spending. We saw infrastructure bills. We saw spending get out of control because the interest rate was zero, essentially. So what's the cost? Well, here we see the federal debt soaring. Now that's the blue line. That's the federal debt held by the public. This is not the larger number. This is the federal debt that's held by the public. So it's fairly conservative. That red line is the interest expense, annualized interest expense. And as you can see, while the debt was soaring, it went up. But interest expense did not rise nearly as quickly because, of course, rates were near zero. But let's look at the end of that where interest expense starts to skyrocket. That happens right after that red line that I marked there. Fed rate hikes begin. Now, if you remember, they only had a quarter-point hike December 2015. They waited a year. Another quarter-point hike December 2016. Another quarter-point hike December 2017. Yet that interest expense started to soar, but just from those minuscule rate hikes. Here it is, magnified. It really started to soar. And that's because, just imagine this, the debt is so enormous at this point and is so leveraged to rates, a very small increase in rates yields a tremendous increase in the bottom line costs, the annual expense. Now, I did some work on this to show what the effective interest rate burden is. If you ask people, even Federal Reserve officials, and I have asked them, what is the interest rate on the federal debt? Today, recently, what is it? They can't give you an answer. They really can't because there are so many different maturities. They're at so many different rates. Nobody can pin it down. So I went back to the Fed's own database and I took their annualized interest expense and just simply divided it by the federal debt at that point in time. And I have never seen anybody else do this. And this is what happens. This is the effective interest rate burden. If you look back in the 80s, you see it gets, or early 80s, late 70s, gets up to 16, 17% effectively that they were paying on the debt. And then it's a long-term bear market in interest rates till just this little period at the end where I point with the arrow, where it just started to rise. And that little blip higher, where the Fed was trying desperately to get to 3% on the Fed funds rate, that little blip higher led to that explosion in interest rate expense. So let's look at the implications of this. Over that long period in that previous chart, the effective interest rate in the federal debt is usually about 3 to 4 percentage points, or 3 to 4 points above the Fed funds rate at any particular time. If the Fed was able to get to 3%, which is still ultra low, but it was their goal, you'd end up with 6 to 7% effective interest rates, which would mean $1 trillion every year being sent in interest rates and interest expense, paid in interest to other parties, to whoever was holding U.S. treasuries, which are the fat cats, which are foreign nations, which is China. That would be politically unpalatable, politically impossible for us to be paying $1 trillion a year. So the Fed is bound on the high side, fiscally, politically, practically. We cannot afford higher rates. So they can't even get to 3% before it explodes out of control. Of course, and these are our conclusions, normal interest rates are no longer possible. So what this means is that real interest rates will be near zero or negative for years. This is extremely bullish for metals and other commodities. Interestingly, it's also bullish for equities. Although it's a different story of equities because, of course, they're near all-time highs. Sovereign debt levels will demand appreciation of currencies. Again, this is not just the dollar. These are all currencies. So if they're going to devalue, What are they going to devalue against? It has to be real things, gold, silver, other tangibles. But gold and silver are primarily the monetary metals. So what are other countries doing while all of this spirals out of control? Chinese gold demand. This is domestic gold demand as determined by the withdrawals on the Shanghai Gold Exchange. Absolutely skyrocketing since, really since the financial crisis. East versus West gold reserves. The gold bars are total sovereign gold reserves. As you can see, they were falling till the 2008 financial crisis. Then they started rising again. That red line is the proportion of Eastern gold reserves versus Western gold reserves. Asians, particularly China, are buying gold hand over fist. Russia is joining the party here. A good bit of the Russian gold reserves, which are in blue there, which simply buying domestic gold production from miners and paying for it with rubles. That's a great trade. It doesn't necessarily mean you like gold. It just means you like gold more than rubles. However, Russia has recently, last year, actually earlier this year, sold all of its U.S. treasuries and started buying gold with it. They are now buying more gold than they are producing domestically. So they are becoming a real impact on the market. Here's a long-term picture of gold, and what I want you to notice here is this is the bottom in 2000. This was a tremendous, as you can see from that channel, a tremendous bull market in gold. The price essentially went up 5 times over from its lows to its peak. What this doesn't show you is that in the mining sector, gold mining stocks did much better. Junior mining stocks that I focus on in Gold Newsletter as a group did very well. We are talking about stocks that went up 3, 4, 5 times, some of them 10 times, some of them 20 or more. And there was tremendous money made in this sector. Now, I need to tell you, there are a lot of caveats. You don't make the money until you take it off the table, highly cyclical, very risky. You don't want to delve in this area unless you take the time and pay the money to subscribe to high-quality newsletters, go to conferences, do the research. But there were fortunes made during this period. I'm going to show you some other shots of where we are in the gold price. As you can see, this is 2011 is that peak at $1,920. We've had a long, long bear market. This was the low, December of 2015. That was when the Fed first started hiking rates after this long period of low rates. And you can see we had a nice burst up. That first burst up in 2016, right here, lasted about 6 months. It was great. We made a lot of money in that in junior mining stocks. A lot of these companies went up 3, 4, 5 times in value during that 6-month period. Now, what I want to show you here, there are 2 lines. A lot of people are looking at where does gold need to get to now. That first lower line is drawn along the tops of the peaks, where we've consistently failed along that area. That's a descending line. It's somewhere in the 1350, 1360 level. Last week, and as of Friday, mid-morning, we had actually hit that 1350 level. And then we went right back down and actually closed down for the day. But that was preceded by about a 2 to 3 week rally in gold. So that's been very encouraging. Tomorrow is going to be crucial. That horizontal line going back to the peak of 2016, that's around 1372 on a spot basis. I'm looking at 1375 as the level we need to clear in this rally. If we do that, I think people are going to look at 1400 as obviously the next key level, but that's a key level that a lot of generalist technical traders are looking at. If gold clears 1400, then it's off to the races. We have no remaining technical resistance, significant resistance, until the price gets up to $1,700 or $1,800. So 1 year, you can see again, the 1 year chart where we are. We're just about to that area, around 1350. If we can get above that, I think we're going to see some more technical momentum. But this is an important point too. We've failed repeatedly at these levels, not only around 1350, but as you can see, 1310, 1320, 1340, around that area. We've seen paper gold traders in the futures market drive the price down toward the end of the month, back below $1,300 before options expiry. So I remain skeptical for reasons of technical analysis and plain old superstition until we get past the end of the month and can remain well into the 1300s. Then I think we can really call this a rally that means something and has some long-term implications. This is an important change that happened very recently. Again, this is from the chartstore.com. This is one of the indicators I've been following very closely over many years, just the 14-week stochastic. As you can see, over this period that I said was very profitable in the market, we had the stochastic staying above that, say, 80 level for periods of time. When it went down, it was sharply reversed back upwards. When we had, after this peak, it spent a lot more time in the lower end, and then when it got to the top, sharply downward. We had been negative on gold recently because of this chart, and I was expecting it to turn around if it were to have a typical seasonal low. I expected it to bottom sometime in late July. In fact, as you can see, it bottomed not back at, say, the 10 level that I expected it to get to, but at the 20 level. About 3 weeks ago, it made a sharp rebound, and it's headed back upward. This would imply another couple of months of upward momentum. And if we get back, if it has this kind of a pattern, it could be a year or more of really strong upward momentum. Remains to be seen, but this is a very important change in the characteristic of the gold market. There's a similar chart, conversely, I did not put up here, of the dollar, where it was whippy for a while up at the top of that stochastic, and now it has headed downward. The important point here, this is the inflation-adjusted price of gold. I should label this a little bit better, but you can't see it way up there, but that represents the nominal price in January of 1980 of $850 and $1980. Today, that's $2,750. So if you feel like we're in a situation that's analogous to the 1980s, where things are a little crazy, they're a little spinning out of control, kind of feels like the 1970s, where you're probably going to have a gold price that's close to $3,000. So that's where we are. So one last remark. Oh, I'm missing a chart here. Oh, I'm sorry. One of the charts that I wanted to show you, and I guess we do have it, how to invest in gold and silver. It's coming up. Physical, bullion, semi-numismatic coins, rare coins. Don't invest in rare coins. Collect rare coins if you like them. That's the only way you're going to make money, is if you collect it as a hobby and really get involved in it. Bullion and semi-numismatic are great ways to have your fundamental foundational holdings in gold. Everybody needs to have some physical metal. I strongly recommend junk silver, old circulated silver coins. You could always spend them in an emergency because they're very divisible, very small denominations, but they're also generally the cheapest way to buy bullion. Futures and options offer you leverage. They are speculations, not in long-term investments. You have to do your homework on that. ETFs and other paper representations, great ways to time the market. Do not use them to replace your physical precious metals. You need those. Mining stocks, senior, junior expiration, offer extreme leverage to the gold price. It's an area that I specialize in on the junior end of the spectrum. Again, these are not for widows and orphans. You need to do your homework. Take the time to study the sector and talk to the right people. Gold Bugs Index. This is an index of all of the gold stocks that are unhedged, that are fully tied to the price of gold. The point here is that the average of these gold stocks, represented by this index, are about 1/4 of the level they were in the 2011 high. And that wasn't really a rollicking bull market for the metals, for the mining stocks. It was more so for the metals. But still, just to get to the 2011 highs, the average big producing gold miner will quadruple in price. So you can imagine what any leverage on that will provide you. Now I'm going to go into some recommendations of juniors that I think on the risk spectrum. Now keep in mind, this is really at the far end of the risk spectrum. These are very risky investments for mining stocks. But inside that micro sector, these are the ones that I think are more certain, less risky. Bluestone Resources has about 2.5 million ounces of high-grade gold in an underground mine that's in Guatemala. That's the risk issue. That's why it's trading so low. It's in Guatemala. But it is going to offer tremendous leverage to gold. It will be in production within a couple of years. I think looking at this, I would have to judge that it's not going to be trading anywhere near these prices if and when it gets into production. I think this is something that has a very good chance. No promises again, because it is in Guatemala and there is political risk. But if it gets into production, it should be fairly valued at probably 3 to 4 times what it is now. And that's, again, a couple of years away. Great Bear Resources, interesting story, is developing or has a big find in Red Lake, super high grade, a legendary place to look for gold. This thing has gone up and down, up and down. When I was at the Orlando Money Show, right around here, I recommended it and it went up. Then it went down, and when I was at the Las Vegas show, it was at those lower levels, and then I went on a panel after it made an announcement and was up 60% from the previous day. And that was a scheduling issue at the Money Show. They should have had me on a day earlier. But that shows you the volatility in this. The key here is if they prove up what they're going to prove up, this stock still has the potential to go up 3 or 4 times or more. It has the potential to have another legendary Red Lake deposit. There's no other junior out there that has this potential, this ultimate size potential. But it is risky. They have a new discovery, 1 hole in it. If they get another couple of holes in it, this stock is going to rise. If that next couple of holes don't hit, it's going to fall. So we're at that juxtaposition point. And again, this kind of illustrates, now I own this stock and I own a good chunk of it, and I have not sold a share, although I recommended other people to do that. I have not yet sold a share. I'm playing this for the long game. But it's an example of this sector. It can be very binary. I apologize for things popping up on my screen. New Pacific. Let me see, I didn't, yeah. New Pacific Resources. This is a massive silver property, silver sand project. Country risk, it's in Bolivia. The primary investor in this, though, is Pan American Silver, that before the company had any significant drilling on it, wrote them a $17 million check. They recently exercised their warrants to double that investment. The idea here, the thought, is that Pan American will eventually buy this company, and I know the company's internal goal is probably that they want to get to around $10 a share before they get bought out. That's where this lies. They're drilling now another 55,000 meters on a project that's very large. They got a lot more land, and they're looking at historic artisanal mining well outside the current bounds of their property and starting to drill there. If that hits, it's going to indicate it could be very large. More certain is that they're going to have a resource estimate at the end of this year, and I think that's going to show a resource in the hundreds of millions of ounces of silver, and I think that will shock the market. Very tightly held, though, very tightly held, but good upside potential. Piedmont Lithium kind of stepping out of this space. Very well-run lithium project in North Carolina. It's right outside, 30-minute drive outside of Charlotte. They've got a great land position, and they're on the way to developing this. I think in another year, this company may not be around, but at the very least, it's going to be at another level of development. I've looked at a lot of lithium plays in this market. A lot of them are highly promoted. and scary from an investment standpoint. This is a very solid group. I do not own this stock yet, but I hope to buy it soon.
You say it may not be around.
Bought out by a larger player. Yeah, I don't think they're going to go into production. And it's a historic lithium mining area. Some of the majors, Albemarle actually operated in the area and still has a plant there. So they would love to get back in. And I think that's kind of the goal, the obvious buyer for this project. Revival Gold has a project in Idaho which has somewhat of a risk discount for this project. And I don't think it's deserved. I think Idaho is actually very pro-mining. They're restoring a lot of brownfields, old mining projects by developing it. They have about 2 million ounces of resources right now. They want to get it up to 3, and they have a mining group, or management group that really wants to go far beyond that and grow it much larger. And that's it. This again is me, Gold Newsletter, goldnewsletter.com, and I'll take some questions in a second. You can go to goldnewsletter.com/moneyshow and get Gold Newsletter for half price. It's basically just $100 a year if you get it at that price. You get all of my recommendations and coverage of the sector. If you're interested in this area at all, you really need to subscribe to that. You can also go to goldnewsletter.com and subscribe to our Golden Opportunities e-letter and get our Investor's Guide to Gold and Silver. That recommends all the other quality newsletters in this industry, all the other quality conferences you can attend. It's free. It's objective. It barely gives Gold Newsletter and the New Orleans Investment Conference more play than anything else, but it does. But really, it gives you all of the other sources of information you need to have. And the New Orleans Conference this year is November 1st through 4th. We've got a lot of big-name speakers, everybody in one place, not only for the gold market. We're covering cannabis this year. We're covering a lot of technology, artificial intelligence, fintech, cryptos, everything you'd want to know. We've got some of the best experts in the world there. So please come. I'd love to see you there. Now, any questions? Yes, sir. It's very significant. The question is, how significant and wide-ranging are all the mergers and acquisitions these days by the majors? Some of these majors are making important moves right now that I think because I think they view it as an important point in the market, and I think they're right. We had Newmont take over Goldcorp, which was very important. Not very good for Goldcorp investors because it was at that stock's lows, but that was important. We had Barrick take over Randgold and install the CEO of Randgold, Mark Bristow, as its CEO. I've known Mark for decades. He is a very aggressive, very good manager of mining projects, but he has a high bar for his mining projects. Everyone has to be richly profitable at $1,000 an ounce gold. That's the bar. And if they're not, he's going to divest them. And what happens at these points in these cycles, at low points before an uptrend, you see majors divest themselves of projects, either through mergers or just bureaucratic mismanagement. And what happens is smaller companies, in this case it'd probably be a lot of mid-tier producers or lower-tier producers, but also some executives from those companies or previous executives will form their own junior companies and take exploration projects. That's happened. Nova Gold, I was the only newsletter, or the earliest newsletter to recommend Nova Gold in the early 2000s when it was a penny stock. We know what happened there. Northern Dynasty, the same thing, one of the largest gold projects deposits in the world. It was spun out of a major company back then. So I think it's going to be a rich and fertile area for aggressive management groups of the smaller end of the spectrum. And there's going to be a lot of excitement as these projects come free. Yes, sir.
Two questions. First one, how does the role of trade wars and retaliation by China and all that fit in affecting the future of gold? The second question, you went through a lot of different options to invest in your shares, but what would you say about the major players like Barrick or Newmont? Are they
Yeah.
a good thing to have?
Okay, your first question was how do the trade wars and other, I guess, political issues affecting, and recent political issues, and I'll make it more general, political crises and issues in general affect gold. I think it's all a sideshow. I think that you invest in gold, you want to invest in gold for the long term, for secular reasons that are going to last, that are really going to power the price higher. And that's always a monetary issue. It always relates back to the devaluation or anticipated devaluation of underlying currencies, always and everywhere. Gold is mistakenly thought to be an investment in times of political crisis, these little flashpoints that'll happen, or trade wars going up and down depending on what Trump tweets out. These come and go in a flash. You're never going to be the first one to buy gold, and you're certainly not going to be the first one to sell in those kinds of situations. So there's really not a factor that anybody other than really a very high frequency trader should consider. It has no long term, there's no logical reason it should affect gold over the long term, and it rarely has any long term effect. That said, this latest rally in gold was started by Trump tweeting out that he's going to put tariffs on Mexico. And that issue that should have lasted a day, you know, the little spike in gold should have lasted a day. Instead, it's lasted a few weeks, and that's very impressive. I think that's more a sign of how oversold gold was at the time, in due for a rally, and it just kind of, the spark kind of ignited the flame. But that's not why gold is continuing to rise. Now, as far as the majors, yes, you can hold the majors. I don't follow those very closely. A gentleman named John Doody, D-O-O-D-Y, is probably the best guy out there, in my opinion, following the big producers. But I do like Barrick with Bristow at the helm. And that is an area that you can focus on, but you can probably do almost as well, and very likely would do better if you just focus on some of the indices. And I like the Gold Bugs Index, the HUI, because that focuses only on the gold stocks that are unhedged, that are purely tied to the rise in gold and leveraged to the rise in gold. Yes, sir, in the back? Yeah. Kirkland Lake Gold is the question. What do I think about it? Very well run, tremendous projects. I was actually the first newsletter writer to recommend that when it was changed its name to Kirkland Lake Gold. God, when was that? In the 1990s. And I recommended it because I recommended Newmarket, which it merged with, and then kind of started this big run of its own. When it did that merger, we sold the stock in the portfolio. We were up 300-400% or something like that. I really shouldn't have, but it was getting into an area that don't follow, you know, the producers that much. I haven't looked at it enough closely to know or get an idea or a view on what the upside is from these levels, but it is a very well-run company with some outstanding projects, and I wish we would have stayed with it in the newsletter. That's let me ask you, or who hasn't had a question yet? We're out of time. Let me go to you, sir. This will be the last one.
Influence of the ETFs, power,
Mm-hmm.
companies,
Yeah.
changing.
Yeah, the ETFs, if you're talking about like the GLD, bullion ETF, those flows are very important. They're not at the really speculative end, like the day traders who use the futures, but they're not at the long-term holders. They're kind of in the middle. It is important to track that, to look at demand for gold from a generalist standpoint, but it's a bit of a lagging indicator. It tends to respond to where gold's going. If you look at the price of gold, it follows it up and down as far as total holdings. I think I have to give up this room for the next presentation. I appreciate all of your questions, and if you have any more, I'll be outside for a few minutes before I have to head off to the airport. I'd be glad to answer some more. Thank you so much.